everybody, my name's Dylan Potter and I'm a partner here at Howe & Rustling. When it comes to saving for college, parents and guardians often search for tax advantage options that offer flexibility and growth potential. One of the most popular investment tools for this purpose is the 529 College Savings Plan. First introduced in 1996, 529 plans provide families with a tax-efficient way to invest money for educational expenses. In this guide, I'm going to dive deep into what 529 plans are, how they're taxed, key strategies to consider, how to change your beneficiaries, and how withdrawals are taxed. Personally, I'm a big fan of 529 plans. I have 3 New York State 529 plans, one for each of my 3 boys. So first, what are we talking about? So a 529 plan is a state-sponsored investment account that allows families to save for education-related expenses. These are things like tuition, books, and certain room and board costs. The funds can be used for K-12 education, post-secondary education, so that's things like college, trade schools, etc., and in some cases, student loan repayment or apprenticeship programs. Ultimately, 529s come in 2 different forms. The first is prepaid tuition plans. These allow you to lock in today's tuition rates for future education. But what we're really going to focus on today is the second one, which are educational savings plans. These work like traditional investment accounts, allowing you to invest in mutual funds or ETFs. While your money is in the account, any investment earnings are tax-free, assuming the funds are used for qualified educational expenses. So before we dive in, it's important to understand that each state maintains its own 529 plan program. So while 529 plans are offered by custodians like Charles Schwab or Fidelity, in order to harness the tax benefits, in most cases, you must own the state's 529 plan where you reside. Here in the state of New York, this can be done by opening an account on newyorksaves.org. That's nysaves.org. One of the most appealing aspects of the 529 plan is their tax advantages. So here's a breakdown of how they're taxed. First, let's talk about contributions. So contributions are made to 529 plans with after-tax dollars, meaning you don't get a federal tax deduction for that contribution. However, many states offer tax deductions or credits for contributions made to their in-state plans. These deductions or credits vary by state, so it's worth researching your home state's offerings to maximize potential savings. For example, as of 2024 here in New York, if you're married and filing jointly and are the owner of a 529 plan, you can deduct up to $10,000 as an above-line deduction on your New York State income taxes for your contributions. So giving an actual example, if you're married and say you contribute $12,000 to a 529 plan of which you are the owner, you can deduct $10,000 of that contribution as an above-line deduction on your New York State taxes. Next, let's talk a little bit about earnings. While your money is in the account, no taxes will be due on any investment earnings or growth that may be generated. And finally, let's touch on withdrawals briefly. As long as the funds are used for qualified educational expenses, so these are things like tuition, room and board, books, fees, etc., the withdrawals are tax-free at the federal level and, in most cases, at the state level. If the money is used for non-qualified expenses, it is subject to income tax on the earnings portion, plus a 10% penalty, and some states may even impose additional penalties. Next, let's talk about changing beneficiaries, or how or why we would do this. So, one of the unique features of a 529 plan is the ability to change beneficiaries. The beneficiary is the person for whom the education savings are intended, but sometimes life gets in the way, right? Maybe the original beneficiary is not going to need all the funds, or maybe they're not pursuing a college or educational path. Life changes. Fortunately, 529 plans allow flexibility in switching those beneficiaries. So here's how it works. So the first piece is, let's look at the IRS rules about what an eligible family member is. For funds to be transferred from one member of a beneficiary's family to another without triggering taxes or penalties, they have to be considered eligible family members. So these include things like siblings, parents, aunts, uncles, cousins, or even the original account holder themselves. The process for changing a 529 plan beneficiary is fairly simple and can often be done online or in some states by submitting a beneficiary change form. The key is to ensure that the new beneficiary is a family member, again, as defined by the IRS, to avoid triggering taxes or penalties. So that brings us to the next question. How often can you change beneficiaries? Generally, there's no limit on how often you can change the beneficiary on a 529 plan, but excessive changes might signal to the tax authorities that the plan is being misused for tax avoidance. However, as long as the changes are reasonable and follow the IRS rules, you should not face any tax consequences for those changes. So, here's a beneficiary strategy tip. If one child in the family receives scholarships, you can shift those funds to another child who may need more assistance or even save the funds for future generations, say like grandkids. Now, let's talk about the taxation on withdrawals from a 529 plan. We can generally bucket these in two categories: qualified and non-qualified withdrawals. Understanding how these withdrawals are taxed is crucial for maximizing the value of your plan. So first, we're going to look at qualified withdrawals, right? These are the tax-free withdrawals. As long as the money is used for qualified educational expenses, again, things like tuition, mandatory fees for the college, textbooks, room and board, etc., the withdrawal is not subject to federal income tax or penalties. Diving into K-12 education, since the passage of the Tax Cuts and Jobs Act, the TCJA, in 2017, families can withdraw up to $10,000 per year from a 529 plan to pay for K-12 tuition without incurring federal taxes. Again, keyword, federal taxes. The state treatment of withdrawals for K-12 vary by your state, so make sure you check in with your state laws. Next, keep the expenses segregated by calendar year. When you're using your 529 plan, you must withdraw funds and pay for those qualified educational expenses in the same calendar year they occur, meaning you cannot use 529 plan money to pay for expenses from a previous year or delay payments into the following year without potential tax implications and penalties. Again, it's based on the calendar year, not the academic year. This differs dramatically from things like health savings account, right? HSAs, where you can maintain receipts forever and then pay them off from the HSA, pay yourself back effectively many years later. Finally, to close out the qualified withdrawals, let's talk about student loan repayments. Under the Secure Act, up to $10,000 of a 529 plan can be used to pay for a beneficiary's student loans. Now let's talk about that next bucket, non-qualified withdrawals. If funds are withdrawn for non-qualified expenses, the earnings portion of the withdrawal will be subject to federal income tax at the beneficiary's rate. This can sometimes be beneficial if the beneficiary is in a lower tax bracket. In addition to the income taxes you're going to pay on those earnings, non-qualified withdrawals are also hit with a 10% federal penalty on the earnings portion. Like I said before, some states may impose an additional penalty or require repayment of any state tax deductions you previously took for contributing to that plan. There is an exception here though, which is scholarships. If the beneficiary receives a scholarship, you can withdraw up to the amount of the scholarship without paying the 10% penalty, although you'll still owe federal income tax, and in most cases state income tax on the earnings portion of that withdrawal. So that brings us to the next question. Who pays the tax? If you take a non-qualified distribution from a 529 plan, whose tax rate applies? Well, the answer is it's the recipient of the non-qualified distribution who's ultimately going to be responsible for that tax liability. For example, if a parent takes a non-qualified distribution from the 529 plan to pay for travel costs, the parents will pay the taxes if the check from the 529 plan is in the parent's name, made out to the parent's name as the recipient. So as you're taking money or distributions, right, from your 529 plan, those distributions may be paid directly to the educational institution, to the beneficiary, or to the account owner. Either the account owner or the beneficiary will have to pay income tax on the earnings portion of a non-qualified distribution plus the 10% penalty. The person responsible for reporting the non-qualified distribution on their income tax returns depends, again, on the recipient of that taxable distribution. Now, let's talk about some key strategies for maximizing a 529 plan, its benefits. A 529 plan is more than just a savings account. It's a powerful financial tool when used strategically. So here's some strategies to consider when managing your own 529 plans. Number one, start early. The sooner you start contributing to a 529 plan, the more time your investments have the potential to grow. Compound interest can have a significant impact over time, especially if you start when your child is young. In the case of my boys, as soon as we had a social security number for them, we started the 529 plans. Number two, we've got to take advantage of the state's tax benefits. If your state offers a tax deduction or credit for contributions, consider maximizing your contributions each year to take full advantage of those benefits. Be sure to verify that your state's rules on deductibility align with your savings goals. However, in many states, like New York, you are required to be the owner of the account to take the deduction. So if you're a grandparent and you have been sending money to your child's 529 plan for the benefit of your grandchildren, take the 5 minutes to open up an account in your name so you can take the deduction for yourself. Number 3, let's talk about gift contributions. Grandparents and other families can also contribute to a 529 plan. In fact, under federal gift laws, individuals can contribute up to $18,000, that's as of 2024, per year per beneficiary without triggering the gift tax. As of 2024, there's also a special provision allowing 5 years worth of contributions, so that's up to $90,000 per person per beneficiary, to be made in a single year without incurring gift taxes or having to file a gift tax return. In 2025, these limits will likely increase to $19,000 per person or $95,000 for what's called the superfunding method that we described above. Number 4, rebalance your investments. As your child approaches college age, consider shifting the 529 plan's investments to more conservative options to help preserve those funds, especially as they're outflowing to meet those immediate educational needs. Many 529 plans offer age-based portfolios that automatically adjust to become more conservative as the beneficiary nears their college years. Number 5, use 529 plans for continuing education. If the account holder decides to go back to school, they can use 529 plans to fund their education. This is especially helpful for career changes or pursuing advanced degrees later in life. Number 6, along the same lines, save for graduate school. If your child completes their undergraduate education without using all of the 529 funds, the remaining money can be saved for graduate school or transferred to another family member for their benefit as well. And that brings us to this next point. What happens if my kid doesn't go to college or we have funds left over in the 529 plan? Well, there's good news here, because beginning in January of 2024, a new 529 benefit went into effect. This new tax-free distribution will allow any unused 529 funds, subject to certain requirements, to be able to be rolled over to a Roth IRA for the same 529 plan beneficiary without incurring any penalty on the earnings at the federal level. This way, you can use their higher education savings to give them a big jump start on their retirement savings as well. There are specific requirements in order to use this new qualified 529 distribution or rollover. First, the 529 account must be open for the beneficiary for 15 years. Second, the Roth IRA must be the same beneficiary as the 529. And third, your contributions, also known as the principal, must have been in your 529 account for at least 5 years before the Roth IRA rollover. Fourth, you can only roll over 529 funds up to the yearly Roth IRA contribution limit, which is $7,000 for 2024. Fifth, the lifetime maximum 529 amount allowed for the Roth IRA rollover is $35,000. Sixth, 529 plan funds must be converted by paying the amount directly to a Roth IRA. In other words, you can't pay yourself and then deposit the money into the Roth IRA later. Seventh, you can contribute to a Roth IRA only if you have earnings from a job. So in other words, the 529 plan beneficiary that matches the name on the Roth IRA must have earned income when the 529 to IRA conversions occur. And finally, Roth IRA income limits do not apply for 529 plan rollovers. So the last pushback we hear is this 529 plan going to hurt my chances for federal aid? So previously, distributions from a grandparent's 529 plan were reported as untaxed student income, which could reduce aid eligibility by up to 50% of the amount of the distribution, which was, in other words, a significant penalty to someone applying for federal aid. For example, under the old rules, a $10,000 529 plan distribution could reduce your grandchild's aid eligibility by $5,000. In fact, with the new FAFSA form, a student's total income is only based on data from federal income tax returns via the IRS. Therefore, any cash support, no matter the source, will not negatively impact financial aid eligibility on the FAFSA. However, At over 200 private institutions that use the CSS profile for awarding their own financial aid, grandparent-held 529 plans will still be considered. So, wrapping up, 529 college savings plans are a versatile, tax-advantaged way to save for education. With tax-free growth potential and withdrawals for qualified expenses, along with the ability to change the beneficiary, 529 plans offer flexibility and control for families preparing for future educational costs and expenses. However, like all these things, it's important to remember that these plans are subject to investment and market risk, right? Your account values can and will fluctuate based on market performance, potentially impacting the funds available when they're needed for that educational or college expense. Understanding how these plans are taxed and employing smart strategies can help you maximize the potential of your 529 plan, ensuring that education expenses are covered with minimal financial stress. So by starting early and making the most of all available tax benefits associated with these plans, you can set up a strong financial foundation for your child or grandchild's future educational endeavors. Thanks so much for tuning in to this episode of Street Smarts, and I hope you learned something.